Hello everyone, Anthony here. In this video, I want to expand on some things that Doug Demuro said in his "Are We in a Car Price Bubble" video. I think for the most part, Doug got things right, but some of it for the wrong reasons, which will give you a better understanding on the whole outlook, or at least the outlook that I see. So I guess the first thing we need to address is what is a bubble, and a bubble is a rapid onset of demand that drops just as quickly or quicker than the onset started. Most common examples of this are like when a new product comes out, like an iPhone, and there's a ton of hype around it, and then that demand drops as everyone who wanted the new iPhone has the iPhone, so that demand is satisfied. Also, it can drop when the next iPhone comes out. Well, then the previous one tanks or whatever. You see that like when the new iPhone comes out, the previous one tanks, and everyone sells their previous iPhone to get the new iPhone. Another thing with bubbles is when something being hyped up was never that great to begin with at all, and then people realize over time or all at once, usually like very quickly at once, that was just hyped and people were just talking out of their ass, like Dogecoin and Shiba Inu, stuff like that, pump and dumps pretty much. There can also be artificial bubbles, which is caused by the people who control the economy, the Federal Reserve, just manipulating the economy. In this case, what we're talking about specifically here is the Federal Reserve lowering interest rates, bond interest rates. When interest rates are lower, more people want to borrow money because they don't have to pay back as much. They're not paying back as much in interest. Doug mentioned this, and that's true and all that. When the Federal Reserve does this, they have to get the money from somewhere to loan out to these people and corporations, so they print the money. However, this devalues the dollar. The US dollar becomes not as rare and in turn not as valuable. So therefore, you need more dollars to purchase the same item. Again, stuff we know. Doug talked about this. Everyone knows this these days. Not everyone. Most people know this. It's been in the news since like 2008. All the stimulus money paid to businesses in the Paycheck Protection Program and these other stimulus programs and everything, and the stimulus that was deposited directly into citizens' bank accounts was all created this way. The Federal Reserve loaned money to the government to pay for these programs. In order to get that money, the Federal Reserve printed it. One thing Doug said in his video is that everyone was on board with this approach during the pandemic. I just want to say I was not on board with this. Even though some businesses suffered like a temporary lack in demand due to the pandemic, gyms, travel, hotels, etc., because they were seen as spreading the virus and people were scared of the virus and all that stuff. And that was true. They would spread the virus and all that. Other businesses were booming, so like sanitation, healthcare, food, stuff like that. So what I was trying to do was I didn't want any of this stimulus stuff, so I was trying to convince people to switch out of their entertainment jobs or travel, hotel, gym jobs into jobs that had more demand during the pandemic to keep the stimulus down. And I was trying to help people save money and all that. Of course, I don't have like influence over what the government does, and I don't have influence over the entire population of the United States. So what I was trying to do, even though in good faith, it doesn't really work out. So a lot of people had a lot of fear and fear of the unknown mostly. But at the end of the day, fear won out. People were afraid of what's going to happen in the future and how are they going to afford to buy bread and what's going to happen to their jobs and everything like that. Fear won out. So at the end of the day, we got stimulus, which to me was just the easy way out. And all those that disagreed with stimulus and didn't want stimulus were labeled as cruel and heartless, which no one was being cruel and heartless. We were just thinking further ahead in the future, because the long-term effects of decreasing the dollar's value and stuff, pretty bad, because it destroys the dollar's value and puts the country further in debt. And our children and our children's children have to pay back the debt. And also, we can't devalue the dollar that much, because the dollar is the world's currency. All these other countries rely on the dollar, and the United States uses it as leverage to negotiate with other countries and issue sanctions and all that. The power of the dollar, the value of the dollar, makes America safer because we have more leverage to get what we want in a way. But anyway, all this stimulus stuff, it was immediate satisfaction and pain easement at the expense of the future. So I think prices are not going to drop significantly. And Doug actually said this in his video as well. But I want to show you the reason why we're definitely not going to get below pre-COVID price levels. So why do I think that? Well, here's the chart of the M1 money supply. I'm not going to get into too much about the specifics about what this chart is, but you can just look at it about, you can look at it as like the amount of money in the world, kind of. So how does this relate to prices? Well, the Federal Reserve doesn't have any plans to destroy any of the money that they created, thereby decreasing supply, making the dollar have higher purchasing power and dropping prices. However, that's not to say I don't think prices won't go down, just that they won't go down to pre-pandemic levels, because like I said before, the more dollars that there are, the more it costs to buy something because the dollars are worth less. Well, if you don't destroy all these dollars that you created, well, you still have this huge supply of dollars that makes everything cost more. I don't think there's ever been a time, I'm not aware of any time where the Federal Reserve has ever destroyed dollars that they created. And you can think about this like how your grandparents said that, oh, we could buy a bag of candy for 5 cents back in the 1940s. And today, like a bag of candy is like $6, $7. Now, back when the stimulus was first announced and the Fed plans to decrease interest rates and increase inflation, investors knew the effects of that and chose to put their money into assets that hedge against inflation. So basically, in investing, a hedge, like you hedge your bets. You can think of it as like, oh, you hedge your bets. So a hedge is something where if shit hits the fan, well, I have this to back it up or whatever. So the biggest hedges against inflation, it used to be gold. Now it's Bitcoin, Ethereum, and other cryptocurrencies. And other people saw how the stimulus would boost the stock market. So some people chose to invest in the stock market instead of cryptocurrencies and all that stuff. But all these investments rely on one thing, and that's with the Federal Reserve keeping interest rates low. Not really to say that, because Bitcoin, Ethereum, and the stock market, they have use cases outside of hedging hedging against inflation. Like obviously you invest in the stock market, you're investing in, let's say you invest in Walmart. Well, you're investing in Walmart having a use case, which is being a business and making money and staying in business and bringing more value to more people, because the more value you bring to people, the more your stock price goes up. Same with Ethereum. The more use cases it has, the more value it can bring to people, and that increases the price of Ethereum. The problem became, though, that more and more people were becoming aware of the dangers of inflation and started turning against the Fed. So the Federal Reserve kind of has no choice but to raise rates, because otherwise people are going to lose faith in the Federal Reserve, which just makes cryptocurrency prices even higher and the Federal Reserve lose control of the economy, which no one likes to lose control. Not that I agree that control is a good thing, but when you have control, no one likes to lose power and control. So this is what happened in November, December, January, just like a month ago, as the Federal Reserve held meetings to announce their future plans. So every few months they have these meetings called the Federal Open Market Committee, FOMC. And during these meetings, it's like every couple months they announce their future plans for the economy, what they're going to do with interest rates and all that stuff. And this time, in the last couple months, after like 2 years of them saying that they're going to keep interest rates low and near zero, after like 2 years of doing that, they said that they're going to raise rates. Well, investors know that continued lower rates boost investments. So when the Federal Reserve announces that they'll increase rates, it signals to investors, hey, it's time to cash out. And this is what we see happening in Bitcoin, Ethereum, other cryptocurrencies, and across the stock market. Investors basically buy and sell based on news. So if the Fed announces lower rates, it means to put more money into investments. And if the Fed announces higher rates, that means get out. And it takes a while for price markets to stabilize because everyone sells the bad news, crashing the market, and then buys back when more news comes out and people start to realize how that initial news will affect the future. The issue is, though, like I said before, the Federal Reserve isn't going to destroy any of the money printed. And that's why we're not going to reach pre-COVID prices in anything. So investors need to figure out, like, this is what's currently happening in the market. Investors need to figure out a price on the market based on the Federal Reserve's future plans to hike interest rates and the increased price of investments due to inflation. So how does this relate to the car market, you're asking? Because somehow I have to make this relate to the car market because that's the reason I'm making this video. Well, Doug got it right, in my opinion, that special and rare cars will continue to go up because investors are investors. They want to buy something cool and have something to show for the money that they made in the market. But at the same time, they don't want to buy stupid stuff that's just going to destroy their value. So maybe they'll spend like a little bit of money on luxury items like steaks and vacations and clothing, but they're all things that are going to just flush their money down the toilet. So they'll put their money into collectibles, cars, artworks, watches. Some will invest in home renovations, some in real estate. Others will invest in cryptocurrencies and stocks and businesses that have real future, that have the potential to bring more value other than an inflation hedge or other than going up because of inflation. But they're not going to be buying Toyota Camrys and 50 Toyota Camrys or whatever. Another thing with the Federal Reserve increasing interest rates, making it less appealing to take out a loan, that's going to drive down demand for everyday items, which means the chip shortage will subside because people aren't taking out loans to expand their businesses and all that stuff. And prices on everyday, like normal cars, both new and used, will go down. But again, not down as much as pre-COVID levels. And I guess that's like the main point that I'm trying to make in this video. Don't expect prices to go down pre-COVID levels because it's like, what, third, fourth time that I said that. So I guess a couple more things before I go. So the printing of money decreases the dollar's value. I said that 100 times in this video. But that's how Joe Biden achieved increasing the minimum wage. He didn't increase minimum wage. He just decreased the value of dollar. So yeah, minimum wage increased, but everything now costs more. The Great Resignation aided in the chip shortage and supply and logistic labor shortage, as well as people have been living off of government programs brought on by COVID and using that as leverage to quit work and demand more pay. So that's where we get like the supply and logistics issues. One thing no one talks about too is when you want to increase a new hire's pay, you have to increase the pay of all existing employees as well. I was talking to a service manager at a BMW dealership where I used to live a year ago, and he was telling me how he has trouble hiring people because the interviewees want more money than they're offering. And I don't remember if I had time to explain this to him, but I know I just told him you have to increase wages, and I was explaining why, and I wanted to explain why because of inflation and all that stuff, that he had to increase wages. And I think he was like kind of turned off about it because that means that it's not just him going to the higher up and saying, hey, we need all these people need more money to be hired onto the company. They're all demanding more money. I think we should increase wages, because that means that now his wage has to be increased as well to keep it fair between all employees and everything like that. So the reason I'm just saying that is just to put it in perspective. when everyone's saying, "Oh, it's so easy to increase minimum wage and all that," it's really not, because you have to keep everything fair between everyone else. You're not just raising minimum wage; you have to raise everyone else's wage as well. So anyway, to get back to the initial question, I kind of feel like this is a stupid video that I shouldn't even post. But are we in a bubble? Technically, no, we're not in a car price bubble because things will not be an instant drop in prices. Like I said when I described what a bubble is in the beginning of this video. So the money supply isn't being destroyed. The Federal Reserve isn't increasing wage rates fast enough to stop inflation and all out crash the market. So those are the two reasons. It's not technically a bubble because we're not having a rapid crash. It's going to be a gradual crash over the course of a year, or a gradual decline over the course of a year, which Doug said. I just wanted to talk more about the economic side behind it and with the Federal Reserve and all that. Initially, like, we did have a crash, as you've seen in these charts. We did have a crash that was just on the news. There was a crash on the news of the Federal Reserve lowering or hiring interest rates, because people hear the news and think like worst case scenario and sell, and then over time, as you can see now, prices are going back up. Oh yeah, and lastly, you also have to think about home prices as well. The Federal Reserve doesn't want to increase rates that much because then that'll crash the housing market, and all these people have loans out for their mortgages and everything. So if you crash the market and crash the housing market too quickly and too hard, people are going to be in underwater mortgages, which underwater mortgages are basically your loan amount is for more than your house is worth. So say you bought a house in the middle of a market bubble. I don't want to say bubble, but in the middle of a market increase. Say you buy a $300,000 house, and it was before the increase, it was only $200,000. Well, if you crash the market, now you have a $300,000 mortgage for a $200,000 house. But again, with inflation, it's like $250,000 house or whatever. That's just all I wanted to say for this video. Take care, thank you, and goodbye.